After a very good week in the stock market, our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 32.44%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 21.48%. It too is beating the S&P 500. And like in last week's video, later in the video I'll discuss ways to potentially boost the return of our dividend-growth stock portfolio, but it will require giving up some portfolio diversification. Now on Wednesday, the Federal Reserve, also called the Fed, announced it will cut interest rates by 0.5%. This will bring down mortgage rates and the cost of borrowing, but it will also bring down the interest rates on money market funds and other forms of cash that's not invested in the stock market. As interest rates come down, the dividend yields of dividend-paying stocks will look more and more tempting, luring some of those that are sitting on the sidelines to get that cash invested in those stocks. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,455.05 after 142 weeks, a new high for the portfolio. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks. So that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video for those that like tech stocks. And for those that have been asking, I've put the dividend growth stock portfolio on our site. And within a day or two, or sometime this week, I will also put up our high yield portfolio on our site, which is beatthestockmarket.com. More on that on the next slide. Hi, Professor Rex here. If you're new to my channel, I teach college accounting and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action starting 2 3/4 years ago, each Monday I invest actual real world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and investing goals and get ideas of company names that they can do their own research on. And of course, I'm also investing my own money in separate accounts in these stocks. There are timestamps and links in the description of the video in case you just want to jump to our list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,455. Sorry, I forgot to update that number. The portfolio's return has been 21.48% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. For those that have requested it, I've now put the dividend growth stock portfolio on my website, beatthestockmarket.com. This week, I will also be putting the high yield stock portfolio, as seen later in this video, on the website for subscribers. And because the high yield stock portfolio currently lacks any technology stocks, this week I will be adding to my site a list of technology focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow the distribution yields as fast as one like Microsoft or Broadcom, which are both in our dividend growth portfolio. There's always a trade-off. For those that can't afford a subscription, I'll continue doing these weekly videos on the weekend, showing what I bought on the previous Monday. Subscribers will have real-time access to the list of stocks we buy each Monday, as well as real-time notifications when we sell a stock. Subscribers will also get a detailed report of portfolio holdings, and they will get access to the complete history of our trade confirmations. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 32.44%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 23.91% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has zero tech stocks so far, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification, which we'll talk about later. Now remember, the high yield portfolio has only existed for 13 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return. This slide shows the cumulative growth of the dividends we have received in our dividend growth stock portfolio. Our dividends for the last quarter increased 51% over the previous quarter, and our dividends this month, meaning August, that's the last full month, increased 94% over the same month a year ago. So why do we only invest in dividend-paying stocks in our two main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our Classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. BlackRock recently released a report showing that $10,000 invested in Dividend-Growers and dividend initiators grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. So a dividend grower is just a company that has increased their dividend, and a dividend initiator is a company that used to not pay a dividend, suddenly has initiated a dividend. Now that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay a dividend by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing stream of income for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are two examples of stocks growing their dividend payouts over the years. First stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 8.21%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And I would predict that they're going to increase their dividend in the fourth quarter of this year. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I'd started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds, but are also riskier than bonds. But you certainly will not find a bond that pays anywhere close to yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck, since most people get paid every other week? I personally am investing a lot more than that in these dividend strategies, but for classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck for this model portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discussed in my class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. And for our Classroom Dividend Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. Now, inflation was high that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And then we split that up each week into 10 different dividend-paying stocks. Now, a very popular exchange-traded fund called an ETF that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our Dividend-Growth Classroom stock portfolio's annual return is 21.48%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 11.78% per year, a difference of 9.7% per year. Now, our high yield portfolio is also outperforming SCHD, but by an even larger margin. Obviously, there's no guarantee that our portfolios will keep outperforming SCHD at such a high rate. But I've been gradually selling off my personal SCHD holdings, about $2,000 to $3,000 a week, and reinvesting in our 2 dividend-paying Classroom stock portfolios. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be value traps. This slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, moves back to the top spot. Both Evercore and Broadcom have total returns over 200%, which means the investment has tripled. So far, those 2 stocks have tripled and 4 stocks have doubled their initial investment. NextEra Energy, an electric utility, makes a list with a 67.3% total return on its initial investment in less than 12 months. Pretty crazy for a boring utility. Stocks in yellow have been sold. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column in the middle of the slide, specifically the category called dividend growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% or so of investments so far have been invested in usually smaller under the radar companies that have recently started paying a dividend. These under the radar dividend paying stocks tend to be riskier because they're usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. And upcoming on Monday, I plan to buy a new under-the-radar dividend payer. This slide shows our best performing dividend stocks this week. It does not include dividends. Last week, we had so many stocks that were up over 5% that I need to break this into 3 slides. 1 slide for each portfolio. Those portfolios being dividend growth, high yield, and then technology. This slide is for our dividend growth portfolio. I apologize if it's hard to read, but many of them were small stocks, which should theoretically benefit more from lower interest rates. Remember, the Fed lowered interest rates this week. The best performers this week were Worthington Steel, up nearly 10%. Nike, also up nearly 10%. Finia, another small one. Clear Secure, another small one. And then Evercore, our best performer. This slide shows our best performing dividend stocks this week for our high yield stock portfolio, which has far fewer stocks in it. The best performers were M&T Bank at 6.3%, Darden Restaurants 6.2%, EOG Resources, PNC Financial, Franklin Resources, Bank of New York Mellon, Morgan Stanley, and Goldman Sachs. And this slide shows our best performing stocks this week in our tech portfolio. The best performers were CrowdStrike, Shopify, ServiceNow, Cloudflare, and Salesforce. Now remember that, this part on the left, it says our best performing dividend stocks. These are not necessarily dividend stocks. These are technology. Some do pay a dividend, such as Salesforce, even though it's very small. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about stocks we sold this week. We did not sell any stocks this week, which is usually what happens. It's mostly buying, occasional sales. Well, we made our biggest sale yet in the previous week, which was Devon Energy. We didn't sell anything this week, but this week we had to reinvest our Devon Energy proceeds, which we'll talk about in a second. Now let's talk about the dividend-growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week. But remember, we only buy 10 per week. I list 15 as a bonus for you. We purchased the first 10 stocks on the list that are not in the yellow highlight. So in other words, Allegiant and Microsoft. Stocks in yellow have already grown to be 4% or more of the portfolio. So we did not invest more in them this week because we want to build a more diversified, less risky portfolio. As we'll talk about later, might be able to boost the portfolio, the performance of the portfolio by not limiting, but that increases the risk of the portfolio. With the recent volatility in tech stocks, lately we've seen several make it back into our top 15 list. They are Applied Materials, Lam Research, ASML, Microsoft, and Qualcomm. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week, when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on the broker's auto reinvest feature, but we think it's more ideal to reinvest in our top rated stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. The table on this slide includes the company's sub-industry, how undervalued they are according to research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Comcast, ASML, and Qualcomm. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology here, used here, indicates that they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. We'll get to the high yield strategy later. The stocks with the highest yields were in order: Bristol-Myers, Chevron, HF Sinclair, Morgan Stanley, and PNC Financial. Now remember, this dividend growth stock portfolio is a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock and the next few slides. This week I purchased over $2,000 of these stocks as I reinvest dividends and gradually transfer out of my main dividend ETF and buy these individual stocks instead. I'm also trying to tweak the buying strategy for my own account a bit to see if we can boost returns. I'll share the results with you once I have enough data. Always experimenting. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, usually smaller, under-the-radar dividend-paying companies that have recently started paying dividends. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. All of the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Let's see, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Nike, Microsoft, and Huntington. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Applied Materials, Lam Research, Bristol Myers, Comcast, Chevron, PNC Financial, and Morgan Stanley. All of these earned an A or A plus grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In your list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Applied Materials and Bristol Myers. They earned an A- or better grade. The companies with the best combination of recent dividend increases, yield, and potential for future dividend increases are Applied Materials, Lam Research, Bristol Myers, and Comcast. Here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that had recently been received and any sales we made the previous week, and then invested we invested the total in the top 10 stocks on our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater. And as mentioned earlier, we sold Devon Energy, and then we had to reinvest this last week. Devon Energy for this portfolio was not very big, but it was a large position for the high yield portfolio, which we'll see later. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to try to boost the portfolio's returns. Now each week, we buy 10 different dividend-paying stocks ranked 1 through 10. And I'm finding out the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost your portfolio returns is to buy only the stocks in positions 1 through 5. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. Remember, we got close to 100 stocks in this portfolio. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. In other words, let your winners run and keep investing. Normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. By doing this technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified, because the ultimate goal of dividend investing has the dividends cover all of your expenses plus generate extra income for vacations, travel, etc. I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point 1. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and Repositrax, 97% gain, also in 12 months. On average, they have not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar dividend payers are very small companies, and small stocks have not performed as well recently compared to large stocks. Like the previous strategy, this method reduces portfolio diversification. And finally, number 4, sell when a stock is fairly valued, even if the dividend and quality metrics are excellent. So what does that mean? So we don't sell often in the portfolio, definitely not weekly. and tend to only sell if the company cuts a dividend, or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50%. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology, because remember there's lots of different ways to invest successfully, and if that valuation methodology signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we are buying, or maybe even the top 5. The downside would be higher turnover in your portfolio, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this fourth strategy is the most difficult to implement because you have to implement your own valuation methodology. Now, here's a new slide for this week. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For model portfolios, we invest weekly, but there's no hard and set rule that says to invest weekly. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. Now, when I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week, as opposed to every other week, is you get more diversification because the list of stocks changes every week, at least by a little bit. So if one doesn't mind less diversification in the portfolio, option 1 is to invest every other week or even monthly instead of weekly. That could simplify things. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just be very small parts of your portfolio as you let your winners run. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a lowly teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, Microsoft announced another dividend increase this week, boosting its dividend by 10.7%, meaning it's maintaining its 5-year dividend growth rate. Microsoft is a great dividend grower. The last 21 dividend increases for the portfolio have an average of 9.4%. This slide shows stocks in our portfolio that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. And it looks like we got another stock split coming up on October 10th, that being Lam Research. And here's a look at the 10 stocks that make up the largest portion of the Dividend-Growth portfolio as of Sunday. Currently, 5 stocks comprise 4% or more of the portfolio, with Allegion still leading the way. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. As mentioned before, it's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now, our portfolio holdings for the Dividend-Growth portfolio are at 98. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. This week we did it twice, and I'll talk about that later. The thing that was time consuming was creating the spreadsheet. It took 2 years of hard work to create. All right. Now let's talk about our high yield dividend paying stock portfolio. I've had several older students who are closer to retirement take my classes. They're more interested in stocks with a higher dividend yields, and they asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into a separate portfolio, and these are stocks with higher dividend payouts. In other words, higher dividend yields. The portfolio as a whole has an annualized total return of 32.44%. I did not predict that. I thought it'd be much lower. Since the portfolio has been in existence for 13 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for 2 3/4 years. Currently, the high yield portfolio's dividend yield is 4.14%. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be better geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 4.89%. Now, 2 strategies are being implemented in this portfolio, as you see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than strategy 1 in an attempt to try to get the best of both worlds, both high yield and dividend growth. So which one has been performing better? Well, at first it was strategy 1, and then now lately it's been strategy 2. The average investment in strategy 2 has provided a total return of 17.44% and has been held for an average of 176.1 days so far, which is an annualized return of 39.5% using Excel's rate function. Now, the average holding period went down this week because we split our purchases up this week and made them on Monday and Thursday. So Thursday's purchases have only been held for 2 days, which brought down our average holding period. I'll talk about the rare extra purchase day on the next few slides. Now, it's not likely that the portfolio can keep up an annualized return that high, since stocks historically average 9 to 10% each year. So keep your expectations in check. On this slide, we're looking at the high yield dividend paying stocks we bought this week. And because the high yield stock portfolio currently lacks any technology stocks, and for those that want to add diversification to this portfolio, this week I will be adding to my site a list of technology focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields do not have the chance to grow their distribution yields as fast as one with a lower yield like Microsoft or Broadcom. There's always a trade-off. One thing that's different about this higher yield strategy versus our dividend growth strategy, which we talked about on the previous slides, is we only purchase 8 stocks, not 10. And we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1, as you can see in red, and 4 stocks in strategy 2, as you can see in green, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality of B- or better. The 4 high-yield stocks we bought this week while implementing strategy 1 are Bristol-Myers, Chevron, Morgan Stanley, and PNC Financial. And the 4 high-yield stocks we bought this week while implementing strategy 2 are the same 4 stocks, just in a different order. I prefer it when there's a little bit more diversification. This week's purchases have an average yield of 4.2%, with Bristol-Myers coming in at the highest at 4.9% dividend yield. Now, as I just mentioned, one thing that was unusual about this week's list was the 2 sets of 4 stocks were the exact same companies, just in a different ranking order. Normally that's not the issue, or normally that's not an issue, but on the previous trading day, which was the Friday, we sold Devon Energy. Now Devon Energy, because this is a more concentrated portfolio, was a large position of the portfolio, so we had a lot of money to reinvest on Monday along with our weekly investment. That meant we had an unusually large amount to invest, and we would only be reinvesting across 4 stocks, because remember, they're the same 4 stocks, just in a different ranking. So I decided to invest only some of the cash we had on hand and reinvest later on Thursday, hoping Thursday's ratings would provide us with at least a slightly different ranking, which it did. Now this is probably just making things more overly complicated, but it did help with increasing the portfolio's diversification. If you don't care about the diversification, it would have been way simpler just to reinvest everything on Monday. It created more work for me. I'll show you Thursday's ranking and the stocks we bought in a few slides. Here's a look at Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stock with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Now here are the ratings on Thursday. Remember, I took Devon Energy's proceeds from the sale of Devon Energy on Friday and reinvested part of it on Monday, and then I reran the ratings on Thursday and reinvested the rest on Thursday, just so we could try to increase the diversification. So when I reran the ratings, we got the fresh list of stocks to reinvest the rest of the funds. As you can see, the new ratings meant we added enterprise products, which yields a very high 7.1%. So splitting that big reinvestment into 2 days did increase the diversification by 1 stock. And here is a look at Thursday's ratings for competitive advantages, management, and financial health. And here's, on this slide, you can see Thursday's grade for recent dividend growth and current yield, as well as recent dividend growth history. Again, it would have been just much more convenient and simpler just to reinvest all the proceeds from Devon Energy and reinvested it all on Monday instead of doing the ratings again on Thursday. Going forward, I will probably just reinvest all on Thursday instead of making myself do more work and complicating things. Here are our trade confirmations from last Monday for the high yield stock portfolio. Remember, we took the weekly deposit plus any dividends that had recently been received and part of the proceeds from the sale of Devon Energy from the previous Friday, and then reinvested in the 8 stocks on our buy list for the week. And here are Thursday's trade confirmations for the high yield stock, where we reinvested the rest of the Devon Energy sales proceeds. All right, now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in this portfolio, but are both in the communication sector, but they are technology focused. So far, the portfolio has increased 25.2% in less than 9 months. In comparison, technology ETF with a ticker symbol XLK is up 16% over the same period. Best performers so far are NVIDIA, 141%, Meta Platforms, 64%, Broadcom, 59%, SAP, 54%, Pure Storage, 46%, IBM, 38%, which still surprises me, and ServiceNow also up 38%. Now, back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. And because it's technology stocks, you can imagine that the performance has been very volatile, way up and way down. Now, I hesitate to call this a portfolio since it's limited to only one sector, but it's been a wild ride to follow. Since the portfolio has started, it has outperformed the two dividend portfolios over the same time period, but that's a short time since this was started on April 29th of this year, and its volatility has been very extreme. So how is the portfolio different from the $1,000 portfolio on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon and Meta. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. And they may pay a dividend, they may not. As you can see, NICE and Shopify. And, ZS, I forgot. ZS, I did not add the ticker symbol. So ZS at the bottom, where it says not found in ticker classification, that's Zscaler. And that's a new one in our portfolio, first time. So the average investment so far has been held for 74.1 days and has produced an average total return of 6.96%. Using Excel's rate function, that's an annualized return of 39.3%, but with extreme volatility. If we'd instead invested our weekly investment into XLK, instead of a 6.9% average return, we would get an average return of 2.6% with the same holding period. Note that all these stocks are higher quality, meaning they must have a quality rating of B- better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks because many stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use the valuation methodology we discuss in class that can be used in all large stocks, whether they pay a dividend or not. So the four top-rated stocks, or technology stocks last week, were Lam Research, ASML, Applied Materials, and Taiwan Semiconductor. Wow, that's a lot of blabbing. My voice, I'm starting to lose my voice. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. Finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find the dividend growth stock portfolio on beatthestockmarket.com, and sometime this week, I'll have the high yield portfolio up there too, with real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about portfolio holdings. And I'll get up the list of technology-focused investments that also provide dividends for those distributions, for those that want to increase the technology allocation to their portfolios. So I'll see you again next week with a list of stocks we'll have purchased on Monday. See ya.